If the biggest buyers of government bonds stop buying, who will take their place? In a world where debt is often seen as a burden, there's one question that keeps economists awake at night. What happens when the biggest buyers of government debt stop buying? For over a decade, central banks have been the largest players in the bond market. These institutions, responsible for ensuring the stability of the global economy, have been massive buyers of government bonds. But by 2026, they will begin to reverse this trend. As they unwind their balance sheets, trillions of dollars in public debt will be put up for sale. This raises a critical question. Who will buy the bonds when central banks sell? To understand the gravity of the situation, we need to go back and look at the role central banks have played in bond markets over the past several decades. From the early days of the Bank of England in 1694 to the creation of modern central banks, the practice of buying and selling government bonds has been a cornerstone of economic policy. In fact, the role of central banks in bond markets has evolved significantly, especially in the wake of the 2008 financial crisis. To keep economies afloat during the crisis, central banks around the world, including the Federal Reserve, the European Central Bank, and the Bank of Japan, embarked on a new strategy: quantitative easing. Quantitative easing, or QE, was a revolutionary approach. In simple terms, central banks began purchasing massive amounts of government bonds and other assets to pump money into the economy. This was done to keep interest rates low, encourage borrowing, and stimulate economic growth. But now, in 2026, as economies begin to recover, central banks are shifting gears. They're starting to reduce their bond holdings, and this process is called unwinding. The sale of these bonds will have far-reaching implications for both the bond market and the global economy. As the Atlantic Council points out, the question is no longer about whether the bonds will sell, but who will be buying them. Stay tuned as we dive deeper into the history of central bank bond buying, why they're unwinding their balance sheets, and the potential consequences of this massive shift in the bond market. To understand why this unwinding process is such a big deal, we need to take a look back at the history of central bank bond buying. It's not a recent phenomenon. In fact, it goes back centuries, and it's deeply tied to the evolution of modern finance. The story begins in 1694 when the Bank of England was established. At the time, England was in the midst of a war with France, and the government needed money to fund the conflict. But instead of simply taxing citizens, the government decided to borrow money from private investors. In return, they promised to pay interest on the debt, creating what we now know as government bonds. This was revolutionary because for the first time, governments had the ability to borrow money that they didn't yet have by offering promises to pay back with interest in the future. And this new financial instrument, the government bond, became the backbone of modern finance. As the Bank of England grew, so did the idea of government borrowing. Other nations began to adopt similar models. France followed suit, issuing its own government bonds. The newly independent United States also adopted the concept of government bonds to finance the revolution and later its westward expansion. For centuries, national debt wasn't viewed as a failure, it was a symbol of credibility. The ability to borrow money through bonds showed that a country was trustworthy and capable of repaying its debts. In fact, borrowing became a measure of a nation's strength. Empires no longer conquered land to extract gold, they issued bonds to generate revenue through interest payments. Fast forward to the 20th century, and the role of central banks in bond markets became even more prominent. After World War II, countries like the US, Japan, and the UK saw their national debt skyrocket. But instead of collapsing economies, these countries relied on their central banks to help manage the growing debt. The Federal Reserve, the European Central Bank, and the Bank of Japan all played pivotal roles in this process, not just managing the money supply, but actively buying and selling government bonds to stabilize their economies. This practice allowed central banks to control interest rates, manage inflation, and ensure liquidity in the financial markets. But as we now know, this was a temporary fix. Despite all the money pumped into the system, the global economy struggled to reach pre-crisis growth levels. And in the years following the crisis, central banks kept buying bonds, maintaining the policy of QE, keeping interest rates low and ensuring that financial markets remained liquid. But as economies recover, central banks have started to reassess their approach. This brings us to the present day, where we are witnessing the process of unwinding, a process that could have far-reaching consequences for the bond market, interest rates, and the global economy. So the question remains, when central banks stop buying, who will step in to take their place? That's what we'll explore next. As central banks reach 2026, central banks are starting to unwind their massive bond holdings. The Federal Reserve, the European Central Bank, and the Bank of Japan have all signaled that they will begin to reduce their balance sheets after years of extraordinary bond buying programs. But what does this mean for the bond market? To put it simply, unwinding refers to the process of central banks selling the bonds they purchased during the years of quantitative easing. These central banks hold trillions of dollars in government bonds, assets they accumulated over the past decade. For example, by 2025, the U.S. Federal Reserve held more than $8 trillion in assets, with a large portion being U.S. Treasury bonds. The European Central Bank and the Bank of Japan hold similar amounts in their respective markets. Now, as central banks begin to sell off these bonds, there are several key factors to consider. First, the sale of these bonds will increase the supply of government debt on the market, and with more supply, the price of those bonds will likely fall. When bond prices fall, their yields, the interest rate that bondholders receive, rise. This is a simple economic principle. When there's more supply of something and the demand doesn't immediately rise to match it, the price drops. But here's the catch. Who will buy these bonds if central banks are no longer the buyers? Will private investors fill the gap? The Atlantic Council points out that as central banks sell off their bond holdings, private investors will be left to pick up the slack. But this isn't a simple transfer. For one thing, these private investors will likely demand higher yields to compensate for the increased risk and the prospect of an oversupplied market. This means that the cost of borrowing for governments, businesses, and consumers could rise, as bond yields serve as a benchmark for other types of loans. If yields rise across the bond market, we could see a ripple effect throughout the global economy. Mortgage rates could climb, making housing less affordable. Corporate borrowing costs could increase, potentially slowing down business investment. And with higher yields on government debt, countries with large deficits like the United States could face higher interest payments, putting further strain on their finances. But the story doesn't end there. The unwinding of central banks' balance sheets also brings another potential risk: financial instability. For years, central banks have been the stabilizing force in the bond market, ensuring that the financial system remains liquid and that bond markets function smoothly. But as central banks step back, there's a possibility that private investors might not have the same ability to manage market fluctuations or intervene during periods of stress. In fact, we've already seen hints of this in recent years. During the COVID-19 pandemic, central banks stepped in quickly to buy bonds and stabilize markets. But in 2026, without central bank support, there's a concern that bond markets could become more volatile, especially in times of crisis. What's more, the unwinding of central banks' balance sheets is happening at a time when inflationary pressures are still a concern. Central banks are raising interest rates to combat inflation, which will make it even more challenging for governments to borrow cheaply. In fact, many governments are already facing mounting debt levels. The U.S. alone is projected to owe over $38 trillion by the end of 2026. As central banks unwind their bond holdings and interest rates rise, it could become more expensive for countries to refinance their debt, potentially leading to fiscal challenges and even sovereign debt crises in the worst-case scenarios. So who's going to buy these bonds? Private investors for sure, but with the market potentially flooded with government debt, the question becomes whether they'll have the appetite to purchase these bonds without demanding higher yields. The answer to these questions could shape the future of the bond market and have major implications for the broader economy. In the next section, we'll dive deeper into the players who could step in to purchase these bonds and explore how the shift from central banks to private investors might play out. We'll also discuss how this unwinding process could change the way financial markets operate both in the short term and in the long term. Stay tuned. As central banks begin to unwind their bond holdings, one of the biggest questions is who will step in to buy the bonds that they are selling? To understand this, we need to look at the potential buyers of these bonds and how the dynamics of the bond market might shift. 1. The role of private investors. Private investors, including pension funds, mutual funds, and insurance companies, will likely play a significant role in purchasing these government bonds. These institutions, responsible for ensuring the stability of the global economy, have been major buyers of government debt. But as we reach 2026, central banks are starting to unwind their massive bond holdings and eliminate their quantitative easing policies. With the sale of these bonds increasing the supply of government debt on the market, the question is who will be buying them when central banks sell, and how will this shift affect the bond market? 2. Sovereign wealth funds. Sovereign wealth funds, the investment funds owned by countries, are another player that could step in. Countries with large reserves of foreign currency, like China, the United Arab Emirates, and Norway, manage these funds and often use them to invest in global assets, including government bonds. As central banks sell off their bond holdings, sovereign wealth funds may increase their purchases, particularly in markets where yields are high and the currency risk is manageable. However, the problem here is that these funds may only be able to absorb a small portion of the debt. After all, they have their own national priorities and may not be willing to hold so much foreign debt when their own economies face challenges. 3. Hedge funds and private equity. Hedge funds and private equity firms are also potential buyers of government bonds. These entities are often more willing to take on risk, especially if they believe that the bond market is undervalued or if they expect yields to increase in the future. While hedge funds have the ability to absorb large amounts of debt, they are not traditionally the primary players in the bond market. Their interest in government bonds will depend on how the risk-reward equation plays out. If they believe that